Hey everybody, it's me, Greg Mannarino. How are you today? It is Wednesday, December 16th, 2015. To say the least, this has been a very interesting week with regard to these markets, what the Federal Reserve is attempting to do starting today, what's been occurring in the debt market as well, and we're going to talk about all of that. Let's start off with this because I did a video last week on Friday where I had talked about what we can expect with regard to the Federal Reserve this week and the markets overall this week. If you remember last Friday, the stock market took a major hit. The Dow Jones Industrial Average fell over 300 points. There were bears running all over the place. Everyone was very fearful about this week, and I said, no, 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 no. I explained to all of you that you have to look at things from a different perspective. That is the opposite side. When you have too many bears, you need to be bullish. Well, that's exactly what I did and what I explained to all of you. And if you were to go back and watch the video that I did this past Friday, it was literally prophetic. Every single thing I said would happen this week with regard to these markets and the Federal Reserve has happened. And you know, I think I got that so correct. It's frankly scary. But let's talk about what we can expect moving forward here. And I've gotten a lot of questions from a lot of you here. So let's try to cover that. Let's start off with this. I had gotten a lot of comments and questions about what's occurring here in the junk bond market, the debt market. We saw a lot of turmoil there. Frankly, I'm not concerned about it. I know a lot of you are going to be shocked to hear me say that. Why am I saying this? First of all, if you follow this blog, you know my work. I tell you, I always watch the bond market. The debt market, people, is the largest part of this market. That's the specific section of this market that world central banks have chosen to manipulate, interest rates lower, and that has bled off to everything else. Everything prices off of the debt market. However, the junk bond market is called junk for a reason, high yield. So again, when you can expect this kind of turmoil to occur from time to time. We've seen this before. This is nothing new. It doesn't rattle me at all. I don't think, at least at this point, is going to bleed off to a higher rated debt. You understand? Okay. So for all of you out there that having all these fears about what may happen in the short run, I want to talk about that too. So let's put the debt market or the junk bond market over here just for now. I believe we're going to see some stabilization over there. So again, last Friday, everyone was bullish, very bearish with regard to this market. I said, no, this market was going to rally this week and more than likely rally off of anything that the Fed would do with regard to a rate hike. I also said if they did not hike, the market would melt down. Federal Reserve credibility was clearly on the line, and this is why they have decided to attempt, let's think about this, attempt to normalize interest rates by raising 25 basis points or 0.25%. So we've had abnormal interest rates for the past 9 years. There was a relief rally, like I said, would happen. And I don't believe we're done here. This is what I want to really talk to you about now. If you recall, back in May, I was the first and possibly only guy on the planet, literally, to nail the top of this market almost to the day. Other guys have called the market top later than I did. I was the first. Until someone can show me proof that I was not the first, I will continue to say that. I've gotten so many people really who have written to me saying, well, so-and-so said this in June. Someone said this in July. So what? I said it first. Okay? So, got to have a little fun with this, people, once in a while. Don't you agree? All right, so here's where we are at this time. These markets, again, have been very interesting lately, but again, very, very predictable. Today, if it were not for crude oil being under a lot of pressure, this market would have gained even further, maybe 400 points. The Dow did finish up 225, triple-digit gain yesterday, triple-digit the game before that, just like I said. Now, I believe at this point, because we got this rate hike out of the way, we are going to continue into a little bit more of a relief rally or a Santa Claus end of the year rally. But we always need to be thinking ahead here. So what have I done for all of you? I made up a lovely chart, which I want you to have a look at. If you're interested, you can find it on my website, traderschoice.net, on my equity list page, for which I will paste or put a link right down here in the description of this video and in the comments section. Click on that. It'll take you right to my equity list page. Scroll down on the page, you're going to see a nice chart there. It's a 5-year chart of the S&P 500 weekly. To me, at this point, it looks very bullish short term. Now, let's keep that in mind here. Very bullish short term. Now, I'm not saying that this market is going to vault 1,000 points in a linear fashion. It never does. Could it? It could. But more than likely, we're going to see more of a random walk with this market creeping higher to hit resistance, which I put for you on that chart. When we hit that resistance, and I believe there's a very strong possibility that we will, this market could roll over hard. That could be just a few weeks from now. Well, I promise to keep all of you on top of it. What you have to keep in mind with regard to these markets, they're absolutely dynamic. Things are changing daily. This is why it's so hard, I think, to be a trader like myself. You need to stay on top of this and be willing to adjust your thinking very rapidly. A lot of people have a hard time doing that. You have to understand the markets are alive, and living things can be unpredictable. Again, it's the collective consciousness of all the people that are involved here. So you need to try to get into the overall head of these markets to make it work for you. And that's really what I'm trying to do here. Take a lot of the guesswork out for all of you. And so we can make this work here. You know, number one and number two, you still need to be betting against this debt. Despite the fact that the Federal Reserve is trying to normalize rates, they are still extremely accommodative, and they are printing cash out of thin air at a blinding pace. The last video I did, I talked about this, and I actually put a link to the debt clock where you can see this in real time. It's frightening, absolutely frightening. So you need to be betting against that debt. You need to be holding hard assets. You need to understand what's going on with regard to that market and part of the market as well. So let's talk about a couple of other things. I know this is getting a little long-winded here, but I want you to focus on a few things. And now that the Federal Reserve has stated they're going to attempt, notice my word attempt here, attempt to normalize rates, doesn't mean it's actually going to happen. Okay, a lot of things have to fall into place for rates to begin to rise and normalize. The market's not used to this. There's a lot of tricks that the Fed has to do with regard to interbank lending, overnight rates, charging interest on excess reserves, all kinds of things, for which I'm going to talk to Greg Hunter about next week in an interview we're going to do. I believe it's going to come out on Wednesday. I'll keep you all on top of it so you'll know when you should tune in. I think it's going to be very interesting, honestly. So again, a couple of things moving forward here, people. The Federal Reserve, again, no surprise to any of you that have followed this blog. I told you what would happen this week. It has played out exactly like I said it would. And let's try to keep this going here. I do expect the markets to gain into the new year over the next couple of weeks. Again, this won't be linear more than likely. We could get little pullbacks, but I think the bias here, now that the Federal Reserve is trying to normalize, is higher. Have a look at that chart I made for you. There's a link right down here in the description of this video and in the comments section. Again, scroll down on the page. It's the first chart you're going to see there. It's clearly marked. If you're interested in seeing the video I did on Friday, where I told you pretty much exactly what, no, exactly, not pretty much, what would happen this week, I'll place a link to that video as well in the description of this video and in the comments section. It was frankly prophetic. And again, I'm really trying to keep all of you on top of this so you know what to expect as we move forward and how we can capitalize on all this, because that's what I'm all about here for all of you. I really want us all to prosper here, no matter what happens. So, with a long-term perspective, which means you need to be betting against this debt, you need to be in precious metals. Shorter term, if you want, you can trade this market like me and convert those profits into hard assets. That's what I do. Anyway, with that said, I know this has been a long video. I appreciate all of you hanging in there. Let's see where this goes. Over and out.